Hey everyone, Sherman the CPA here. Today I'm going to give you the top 5 Vanguard ETFs to invest in to build massive wealth. I have personally invested hundreds of thousands of dollars into a couple of these funds because they are low cost, extremely reliable, highly diversified, and most importantly, have a strong track record of producing great returns. Vanguard expense ratios are 75% less than industry average, which means a $100,000 investment into a Vanguard ETF would save you $30,000 in fees alone over a 30-year period, or nearly $300,000 with a $1 million investment over the same period of time. And if you are anything like me, you can just buy and hold these funds instead of paying money to an investment advisor who is just going to turn around and buy these funds anyway. So if you catch my drift here, you can save a lot of money and time by investing in these Vanguard ETFs. But more importantly, these funds are one of the easiest ways to generate great returns over time. Because when you buy one of these funds, you are investing in hundreds of different companies. This is very important because it mitigates your risk over the long term. Every company has a life cycle and will fail at some point. So by diversifying your portfolio across a lot of successful companies, you improve your chances of success in the long term. You could build your entire portfolio with just 1 or 2 of the funds that I'm about to give you. And if you stay until the end of this video, you will learn more about a specific Vanguard ETF that you can add to your portfolio to substantially lower your risk. So if you want great returns, low fees, and easy passive investing, go ahead and like this video to help me spread the word. And let me know your thoughts on this as you listen to this full video in the comments below. All right, so if you don't know, an ETF just stands for Exchange Traded Fund. It is technically a security that tracks an index like the S&P 500, for example. It is completely passive and trades like a stock on the exchange, which is partly why ETF fees are so low. But the stock-like nature of ETFs is a good thing. You can buy ETFs anytime the markets are open, unlike many mutual funds. There is also no minimum investment requirement with ETFs, unlike mutual funds. You would just have to buy the ETF at the share price it is trading for on the exchange. With that said, let's go ahead and get into my list for the top 5 Vanguard ETFs. ETF number 1, Vanguard S&P 500. Also known as VOO. VOO tracks the S&P 500 index, which means you will be investing in the 500 largest companies in the US if you buy this fund. And 85% of active investors fail to beat the S&P 500 in the long term, which means that you will be doing better than most investors by just investing in this fund. It has averaged a 16.5% annual return over the last 10 years and produced a 28% return in 2021 alone. A $10,000 investment in this fund 10 years ago will be worth $46,000 as of the end of 2021. It also has quarterly dividends, which normally yields around 1 to 2% per year. It also has a 0.03% expense ratio, which is next to nothing when compared to similar funds. Now, the magic behind the S&P 500 is in how it weighs the 500 companies in the index. They use market cap weighting to place more emphasis on the largest companies in the index and less emphasis on the smaller companies in the index. For example, the top 10 holdings in the S&P 500 are assigned 30% of the weight of the index at the time of this video. This means that if you invest in this ETF, 30% of your money would be invested in these companies, with Apple leading the way at 6.7% of the entire fund's value. And if Apple's stock crashed and its size decreased, the weight of Apple stock in the S&P 500 index will become smaller and smaller over time and may eventually be removed from the index altogether. I personally love this feature because it basically keeps my money more heavily invested in the largest companies in the index. And if those companies underperform and shrink in value, they will make up less and less of my overall portfolio or get kicked out of the index altogether when they rebalance at the end of each quarter. By the way, if you're enjoying this video so far, make sure you are subscribed to our channel for even more videos that can help you build wealth. All right, ETF number 2, Vanguard Total Stock Market ETF, also referred to as VTI. VTI tracks the total US stock market, which includes small, medium, and large companies that represent nearly 100% of the US stock market. The inclusion of small and medium stocks add a layer of diversification that many investors find particularly attractive. VTI consists of over 4,000 stocks, which is over 3,000 more stocks than the S&P 500. VTI has averaged a 10-year return of 16.29% and produced a 25.72% return in 2021, which means a $10,000 investment in this fund 10 years ago will be worth about $45,000 as of the end of 2021. It also pays quarterly dividends like the S&P 500, which you can elect to reinvest back into the ETF if you would like to. And it also has a very low expense ratio as well, coming right in at 0.03%, just like VOO. Now here's the thing you need to know about VTI. It's market cap weighted just like the S&P 500, which means despite the fact that it includes 4,000 stocks, a large portion of your investment will still be shifted to the largest companies in the fund. For example, here are the top 10 holdings in VTI, which makes up 26% of the fund. And here are the top 10 holdings from VOO, which makes up 31% of that fund. Now, as you can see, it is the exact same companies, just a slight difference in its percent allocation, which means if you buy both of these funds, you will be buying a whole lot of these same companies, which is probably why their historical returns are nearly identical. VOO comprises roughly 82% of VTI by weight. And because of this, a lot of investors add either VOO or VTI to their portfolios, but not both in most cases. Now, I personally like VOO just because it tracks the S&P 500, which is the golden standard for the stock market in general. And I know a whole lot of people who like VTI just because of the extra layer of diversification you get with these small and mid-cap stocks. But let me know which one of these you would choose in the comments below. Anyway, since VTI does not add a fair amount of small cap stocks in relation to the large cap stocks in the fund, let's discuss an ETF that can help you accomplish this. ETF number 3, Vanguard S&P Small Cap 600, also known as VIOO. Now this ETF tracks the returns of the S&P 600 Small Cap Index, which represents 600 small US companies. It is also market cap weighted like the other funds, but since 100% of the fund includes small companies, it will be weighted towards the largest of those smaller companies. For example, Macy's is the #1 holding in the fund, representing almost 1% of the total fund. This ETF has averaged a 10-year return of 14.42% and produced a 26.67% return in 2021. A $10,000 investment in this fund 10 years ago will be worth over $38,000 as of the end of 2021. It also has a 0.10% expense ratio, which is much lower than the 1% average for similar funds like this one. And its average dividend yields are about 1% on average. Now, one thing to keep in mind about small cap stocks is that they tend to be more volatile than large cap stocks, since smaller companies tend to be less stable and more likely to go out of business than large juggernauts. This adds a higher level of risk, but may also produce higher returns. Vanguard rates this fund a 5 out of 5 on the risk scale, whereas other funds covered so far were rated a 4 out of 5. But if you want more exposure to the smaller side of the market to add some diversification to your portfolio, this may be a great addition to it. ETF number 4, Vanguard Real Estate VTF, also known as VNQ. This ETF invests in 171 stocks that are issued by real estate investment trusts, which are just companies that purchase real estate like office buildings, multifamily apartments, single-family homes, and so on. Now, real estate stocks may be great to add to your portfolio because it tends to have a lower correlation to the stock market than other types of stocks. So when most stocks in the market are down, there have been times where real estate stocks were up, and vice versa. Therefore, adding real estate to your portfolio can help diversify it and protect it from steep downturns in the market. Now, this fund has averaged a 10-year return of 11.5% and produced a huge 40% return in 2021. A $10,000 investment in this fund 10 years ago will be worth about $30,000 as of the end of 2021. It has a 0.12% expense ratio, which is much lower than the 1.08% average for similar funds like this one. And its average dividend yields are about 3 to 4% on average, which is much higher than all of the funds we covered so far. This REIT ETF provides an easy way to passively invest in real estate without dealing with the day-to-day of tenants, toilets, and trash. But one thing worth pointing out about REITs is that there are private REITs and public REITs. This would be a public REIT since it is listed on the US stock exchange. However, some REITs, like Fundrise, for example, sell private REITs. And some people believe that private REITs provide higher returns and pay higher dividends. For me personally, Fundrise provided me with a 43% return in 2021, which is a bit higher than the 40% return of VNQ. So not too much of a difference, and it doesn't mean that VNQ won't outperform Fundrise this year. At the end of the day, I think the moral of the story here is to consider adding some real estate to your portfolio to add even more diversification and mitigate your risk. ETF number 5, Vanguard Total Bond Market ETF, also known as BND. This ETF invests in over 10,000 bonds, which are historically used to diversify the risk associated with stocks in a portfolio. Now, bonds are not very attractive from a capital appreciation perspective. When compared to US stocks, it performs nearly 5 times worse on average. So why would anyone buy bonds? Well, buying bonds makes more sense when you look at it from a risk point of view. When you look at the max drawdown between these two assets, you will see that US stocks dropped more than 50% in one period of time compared to a 5% max drop in bonds. So this means that if you invested $100,000 in each investment, your portfolio would have dropped to $50,000 in US stocks or just $95,000 in US bonds. And that is a big deal, especially if you need that money in the near future, whether it is for retirement or for an upcoming purchase. And that is why bonds are so beneficial. They are low-risk investments that can preserve your capital while providing you with reliable and consistent income. With that being said, let's go ahead and take a look at this ETF. The Total Bond Market ETF is rated a 2 on Vanguard's scale of risk, which is the lowest risk profile we have covered so far. This portfolio is composed primarily of US government bonds and other bonds with extremely high credit quality, which is why the returns are so reliable. Now, this fund has averaged a 10-year return of 2.85% and produced a small negative return in 2021 as interest rates hit historical lows. A $10,000 investment in this fund 10 years ago will be worth over $13,000 as of the end of 2021. And the expense ratio with this ETF, like all of Vanguard ETFs, is next to nothing. John Bogle, the founder of Vanguard, recommended that one's bond allocation should be equal to one's age in their portfolio. So under this theory, if you are 60 years old, you would make bonds 60% of your portfolio and would invest the remainder in stocks or other assets. Now, for me personally, I chose to go against this and own 0 bonds. It's because I understand the up and down nature of stocks, and I only make long-term investments that I plan to hold for at least 5 to 10 years or more at a time. And if I can't afford to hold an investment for that long, then I probably won't invest that money at all. However, bonds may be a liquid and more reliable alternative to that line of thinking. Anyway, let me know what you think about all of these ETFs, your investment philosophy, or just your thoughts in general in the comments below. And if you enjoyed this video and want to see more videos just like this one, drop me a line below and I will crank out more videos just like this. Thank you for watching, and I look forward to seeing you in the next episode.